A sudden silence fell across Wall Street, but it wasn't a crash. It wasn't a scandal. It was something far more dangerous. Foreign money was quietly disappearing from the United States. In a single week, $6.5 billion in capital was pulled. Another $8.9 billion in deals frozen. And now, Bank of America is sounding the alarm. A total of $41 trillion in foreign investment is at risk of vanishing. Yes, 41 trillion. That's not a typo. This is the value of all foreign-owned assets in the UC, from stocks and bonds to real estate, tech, and manufacturing infrastructure. And it's starting to unwind because investors are no longer asking if they should flee the American market. They're asking how fast they can get out. So what's behind this mass exodus? And what happens when the financial lifeblood of the U.S. economy starts flowing elsewhere? Let's break it down. For years, America was riding high. Foreign investors couldn't get enough. By early 2025, the U.S. had become the #1 global destination for foreign capital. The total stock of foreign direct investment reached a staggering $41 trillion, a symbol of America's economic dominance and perceived stability. This wasn't just paper value. This money built factories in Michigan, funded tech startups in Silicon Valley, and propped up the U.S. Treasury with regular bond purchases. But that confidence? It's now collapsing. Why? One word: unpredictability. It began with a wave of new Trump-era policies. In his second term, President Trump doubled down on his America First strategy, slapping new tariffs on foreign goods, threatening allies with trade penalties, and introducing proposals like Section 899, which would tax foreign corporate earnings at 20 to 30%. Then came sweeping threats: 100% tariffs on Chinese-linked oil, 50% tariffs on Brazilian goods, and even rumblings of a 10% blanket tax on all imports from BRICS countries. Foreign investors, once eager, began to hesitate. The rules of the game were changing too fast and too arbitrarily. Confidence gave way to confusion. And confusion? To capital flight. In the first quarter of 2025, foreign direct investment in the U.S. cratered, falling to just $52.8 billion. The lowest since 2022. At the same time, Bank of America began tracking something even more worrying: capital outflows. In 1 week alone, U.S. equity markets saw $8.9 billion pulled out. At the exact same time, European and Japanese markets saw $7.8 billion in inflows. Investors aren't waiting to see if the U.S. will stabilize. They're already moving on. Trump officials responded with confidence. They claimed that $10 to $14 trillion in new foreign investment was coming, that America would soon see a flood of capital thanks to strong trade, protections, and tax policies. But the truth was more complicated. Many of these new investments were actually just old deals, repackaged. Others were vague proposals, conditional, speculative, or flat-out fictional. Fact-checkers from the Financial Times, Reuters, and Bloomberg revealed that, at most, only $2.1 trillion of that projected investment had any real chance of materializing. And even those limited deals? Many are now under review or delayed indefinitely. So why should the average American care? Because foreign capital doesn't just sit in vaults. It powers the real economy. Foreign investors own nearly 18% of all U.S. stocks and bonds. They provide liquidity, fund government debt, and support industries from real estate to tech. If they pull out suddenly or gradually, the results could be devastating. Stock market crash. Trillions could be wiped from retirement accounts and pensions. Higher interest rates. As foreign buyers retreat from U.S. treasuries, borrowing costs could skyrocket. Job losses. Manufacturing, tech, and biotech sectors, heavily reliant on international capital, could face mass layoffs. Shrinking innovation. Without foreign investment, Research budgets for AI, life sciences, and green energy could evaporate. This isn't just a Wall Street problem. It touches Main Street. Now layer this financial flight over America's growing debt crisis. As of mid-2025, the U.S. national debt stands at over $37 trillion, a historic high, and it's getting harder to fund. For decades, the U.S. relied on countries like Japan, Germany, and China to finance its deficits. They purchased treasury bonds, invested in U.S. companies, and supported the dollar as the world's reserve currency. But today, that global trust is eroding. Rebecca Patterson, former chief strategist at Bridgewater Associates, reported that foreign investors and policymakers at the IMF and World Bank are now openly discussing ways to reduce U.S. exposure. And this isn't just about tariffs anymore. It's about fear. One of the most alarming shifts in global sentiment is the fear that America is willing to weaponize its financial system, from freezing foreign assets to sanctioning competitors to controlling dollar-based transactions. The U.S. has shown a willingness to use its economic power not just for profit, but for politics. That's a dangerous precedent. It sends a message to investors. Your money is only safe here if your country stays on Washington's good side. For many, that's a deal breaker. While confidence in the U.S. wanes, alternatives are rising. In 2025, the BRICS alliance expanded deeper into Southeast Asia. Indonesia became a full member. Malaysia, Thailand, and Vietnam joined as strategic partners. Together, BRICS nations now represent nearly half the world's population and over 45% of global GDP. They're building their own financial networks, from payment systems to investment banks independent of the U.S. dollar, and they're offering attractive terms to investors. No sanctions, no weaponized finance, no political strings attached. As America tightens its grip, the world is finding ways to slip free. This isn't a short-term reaction to one president. It's a structural shift in global finance. Major financial centers in Frankfurt, Singapore, and Tokyo are adjusting their portfolios, preparing for a world where America is no longer the epicenter of global investment. Bank of America's wealthiest clients, who control over $3.7 trillion, are also repositioning. They're dumping inflation-protected bonds and financial ETFs. They're moving into utilities, defensive sectors, and high-dividend assets. Translation? They don't trust the official story. They're bracing for impact. And then there's the final pillar, the U.S. dollar itself. For over 70 years, the dollar has been the foundation of global trade. But that era may be ending. With BRICS expanding, regional trade deals growing, and digital currencies rising, the dollar is under siege. A serious shift away from dollar-based investment could send ripple effects across every corner of the American economy. Consumer goods could become more expensive. Import inflation could rise sharply. The government could struggle to borrow without raising taxes or cutting spending. The consequences of a weakened dollar are real, and they're closer than most think. According to U.S. Treasury data, a mere 3% decline in foreign holdings would mean almost $1 trillion yanked from the American financial system. To put that in perspective, the S&P 500 is worth about $52 trillion. A $1 trillion sell-off could shatter market stability. And this isn't some hypothetical doomsday scenario. The outflows have already begun. They're slow, strategic, and largely silent, but real. The fuse is lit. The question is how fast it burns. For decades, the U.S. economy was built on a foundation of global trust. Foreign investors saw America as stable, reliable, and worth the risk. But now, that perception is shifting. And if even a fraction of the $41 trillion currently invested begins to leave, the damage could be catastrophic, crushing markets, inflating debt, and triggering a financial reckoning far beyond Wall Street. Bank of America has issued its warning. Numbers are flashing red. The capital flight has already started. And so we're left with one unavoidable question. If global trust in the U.S. economy disappears, what happens to the empire that was built on it?